I'm going to jump right into it. The first topic I'd like to discuss, the debate between fiduciary standard and the suitability standard. Now, just to give a little bit of background, when a client deals with a broker, they are dealing with someone who is operating under the suitability standard. And what this means is that the broker only has to recommend the security that's appropriate for the client given their financial profile. It doesn't necessarily have to be the best investment out there. It doesn't necessarily have to lack a conflict of interest. So theoretically, the broker can make a commission from one product and sell that one, prefer that product over a different product, even though it may not be the best for their client. The result is that brokers typically under suitability standard end up working against their clients and not necessarily for their clients. And the reason is that if you're influenced by commissions to do one thing over another, the end result is the client might end up with investments that are not perfectly suited to their particular situation. So this has been very active debate since the Frank Dodd legislation put out guidance that stated that changes needed to be made and the suitability standard needs to be assessed, especially the way it relates to the fiduciary standard, which is a little bit different. Fiduciary standard is typically what investment advisors operate under as opposed to brokers. It says that you must operate in your client's best interest at all times. So it's quite different. Under fiduciary standard, accepting commissions might potentially influence you to offer one product over another. So many people that work under the fiduciary standard charge a fee based on assets under management and so forth. Now, that's significant because while the two standards are different, investors typically can't tell them apart. So if you would ask somebody how their investment advisor is compensated or what model they're working under, most don't know. They're just unaware. So this has reached the SEC, and this article outlines what we might be looking at as far as this story developing in 2012. Now, the SEC wanted to put out guidance this year to expand the fiduciary standard to brokers who work with retail investors. Now, of course, anytime this sort of legislation comes out, the brokerage industry fights pretty fervently to bypass it or to make sure it doesn't pass because it basically would kill the brokerage business model. So it says here, in a Bloomberg interview, SEC Chairman Mary Shapiro said that the agency would issue a proposed fiduciary rule in 2012 that would be business model neutral and allow brokers working with retail investors to sell proprietary products and charge commissions. So although the intent there is quite clear, it's difficult to assess how investors are going to be able to interpret exactly what's going on with the changes. As it is, there's a lot of confusion going on, and if these models are not clearly outlined as being separate or there's not a uniform standard, then there will be more confusion. It goes on to say that if by business model neutral the intention is simply to make provision for commissions and proprietary products, then I'm not surprised nor too concerned, says a president of a wealth management firm in Florida, who's also a member of the Committee for the Fiduciary Standard. If by business neutral the result is the one sought by many in the brokerage and insurance industry, which is redefining fiduciary as an enhanced suitability standard with opt-out provisions, then we will end up with the worst of all worlds. And I think this is actually a really relevant quote because if we bring the two standards closer together, we will end up increasing investor confusion, and in addition, we won't really help investors out because they'll still be dealing with salespeople who may or may not be working against them, and it's really hard to see how it's going to help if we have two different standards that look even more similar to investors. It goes on to say, while there's no doubt that the SEC is trying to walk a fine line given the political and economic realities as it develops the fiduciary rule, promoting a business model neutral formulation is a very balanced approach, and it's consistent with what Shapiro's been saying for a while. By contrast, a strict fiduciary standard would have likely prohibited practices such as selling proprietary products. So what we see here is the tone put out by the SEC is becoming softer as far as implementing fiduciary standard across the board, and they seem to be backing down slowly. It looks like what we're going to encounter is more of what we've seen where investors are kind of caught in a lurch and they don't really know where to turn. In addition, it says, it's no secret that Section 913 of the Dodd-Frank represented a compromise among competing interests. The question of whether brokers should have the same fiduciary standard as investment advisors has been and continues to be very controversial, and Section 913 reflects that controversy. So this is the section, of course, that allows principal trading and proprietary products to be sold, as well as commissions to be charged. It goes on to say, Section 913 creates a fairly complicated roadmap that the SEC must follow in crafting a fiduciary standard. It gives the SEC explicit authority to issue rules that would apply the same standard of conduct that investment advisors have. But it also states the receipt of commissions and sale of proprietary products will not, in and of themselves, be a violation of that standard. And it will only apply to brokers who provide personalized investment advice about securities to a retail customer, which many of them do. So we'll continue to see how this plays out. However, as time passes, it looks more and more that we will end up in the situation that we are now, where brokers have their separate standard and investment advisors have a fiduciary standard that they need to stick to. So we'll see how that develops. It's interesting to see that although this has gotten some traction in the government, it's still sort of a stalled issue. And you can see how the financial interests, they're fighting against it, because every time this issue comes to light, it always gets taken down and doesn't go forth very easily. So we'll see how that story develops. That was something interesting that I wanted to bring up here.